Hi, I'm Charles. I'm with City Credit Union. I've been in the business of other people's money, banking and credit unions, lending and mortgages for 40 years. I've spent my life in this business. My parents were both bankers. The truth is, the business of other people's money is about all that I really know to make a living at. So I'm here doing that and offering this service to talk about what today is the keys to your keys. And when I'm saying keys to your keys, I am talking about big purchases. You will see that Percy is a big part of what I do. Percy is my Great Pyrenees. He's a 130-pound, sweet, lovable dog. He's a part of the TikTok and YouTube videos that I do. So he's got zero experience in banking, but he is very cute, and you will see that he is prevalent in all of the classes that I do. So hope it's not too silly. Check us out on TikTok at Walks with Percy. Walks with Percy. And we're going to have a new video each week to talk about some of the things that we're doing, going a little bit deeper dive into I'm purchasing a car. What can I do? What can be, how can I put myself in the best position to do that? Purchasing a house. Want to buy a house, want to refinance a house. We're going to be talking to a real estate professional that can help us. I'll talk about mortgages. They'll talk about the contract and putting yourself in the best position for that house. Less fees, more money in your pocket, less money going out. We'll be talking about actually items like this is we're in May. So there's graduations happening. There are life-changing events. There are life-changing events that cost money that are coming up. We're going to be talking about college prep, how to prepare yourself. Parents, how to prepare yourself financially for what's about to come. Kids, how to prepare yourself financially for what's about to come, how to navigate this money that is one, maybe I'm going to college, or two, I am launching myself into my life as an adult. How to best position yourself so that you're comfortable and making good decisions and not being desperate. Talk more about that. Um, Also, the keys to life, the keys to enjoying the life. Look, we don't work just to make money. That money is designated to do things for us, whether it's a roof over our head, our transportation to get somewhere, and or to enjoy life, like vacations, like going out to eat. These things, look, we don't want these things to be desperate. We don't want these things to put us in debt, but we want these things. And I will tell you that those wants, they drive us. They drive us to sacrifice. They drive us to do more. And we'll talk a little bit more about that in some other classes. But that's who I am. Please feel free to drop a line. Would be happy to answer any questions that you have. So I said Percy's prevalent in my class. So when Percy, he's 130 pounds. Do you think he likes to eat? He likes to eat. Can I say anything? No, I can't say anything. I like to eat a lot. But when Percy sees a bag of treats, like everything, he's blinders on. Everything else disappears, and he's got to get that treat. Um, really, what does that have to do with large purchase items? Great. That's a great question. So, look, when we get into we're going to buy a house, we're going to buy a car, we see that new and shiny thing. You can have blinders on. We can want that so much that we give up thinking about what the actual cost is going to be. So, what I'm talking about is slowing down and looking at everything. Once you understand a lot of that stuff, you can put yourself in a better position. So these things, especially items like cars and homes, investments, whatever that may, these things can affect the rest of our lives. So it's important to consider those to make sure that we are being thoughtful in this. The excitement makes us miss the math. We don't want to miss the math. The math doesn't lie. Math doesn't lie. It's telling us what the true cost, what the cost of things are. So let's not be so enamored with that new shiny thing, with that bag of treats that we just got to jump in there. Look, we focus on the house, the car, or the upgrades to whatever, and we forget about how many years that might cost us, what the interest is, the total risk in getting involved in that, because we want that treat. So let's just talk about don't miss the math. And here's what we're going to go over the class. I'm going to go over the keys to credit. going to talk a little bit briefly about your credit and how to have that in the best position. Your house keys, things to understand when you are starting out. And this is really a one-on-one, by the way. This is not, hey, I'm going to tell you everything about buying a house. That's going to come later when we do a deeper dive. This is an overview on everything. Your car keys, putting yourself in the best position. By the way, I've got an amazing guest that's going to be coming up in the coming weeks that you'll see on TikTok. You'll also see this on YouTube, and we'll post this everywhere where that we do social media with City Credit Union. But he has been in the car business for 30 years. He is going to pull back the curtain and talk to us about how to best position yourself in cars. So that's coming up, but we're going to do a little overview of that. Also, the same thing for buying houses. I've got a real estate professional that is going to come on, and he's going to talk to me about how to better position you into saving money when you are doing real estate purchasing. So I'm excited about those coming up. Keys to your lifestyle. What making yourself putting yourself in the best position to enjoy the things that you want to enjoy, like vacation, like having a boat if that's your thing, whatever those things that are big ticket items. Um, Putting yourself in the best position of that, and then we're going to talk about the keys to freedom. Keys to freedom are talking about your future. And by the way, I'm very excited about the guest that I'm going to have on for that. He is one of the smartest people that I've ever known. He is, and I'll be honest with you, manages my money, um, manages my money well. We really enjoy what he's doing, and he is going to talk to us about money and investments, and use his wealth of knowledge to help give you a foundation on how to build wealth. So that's coming up in the next weeks in May. So starting out with credit, look, this is really where I come in this very well. I was a lender, I was an underwriter. I have looked at credit, so I'm going to talk to you about the 4 C's of credit. This is about how a lender looks at you when we are making decisions. What do you look like to us? What do you look like? How are we making these decisions? I'm going to talk about the true cost of credit, what this is really costing you. So when you understand what that true cost is, before you sign and say yes to these numbers, understand what the numbers are saying to you. And the payment is not the price. So getting approved doesn't mean that you can afford it. It means that's what they can approve. That means that's the maximum amount, maybe possibly the maximum amount they could approve you for. Talk a little bit more about it. So that's going to be the beginning of this. Starting with the 4 C's. It's one of my favorite things. Look, this, I don't care what lender you're dealing with. They have some aspect in their underwriting guidelines and how they're making decisions about you and whether you can get credit or not. They have these 4 C's within their underwriting guidelines. It may be different ratios, but the overall is similar to every single one of them. And first C is credit score. Look, we all know about credit score. That everybody, wherever I go, people ask me about how to increase their credit score, how to increase their credit score. Look, this is a numerical representation of your financial responsibility. This is just really talking about the historical data of how you have paid, what type of credit you have on, how much you have out there. It is a big overview of your responsibility as a borrower. It is just a number out there, and that's just one of the 4 factors. Now, collateral, that's your loans compared to the value. Collateral, or is it an unsecured, like a credit card, where you don't have any security on that? And I'll talk about security is risk. Risk equals rate. If it's unsecured, like a credit card, this is why the credit card rates are so high. It's unsecured. Here's what that means. If I, as a lender, am giving you $1,000 on a credit card and there's no security to that, if you decide to stop paying it, my only recourse is to hurt your credit. But I'm still out that money. I've still given you $1,000 that you have borrowed on your credit card and you've decided not to pay back. That is risk to me. I have no recourse other than to maybe try to take you to court. By the way, if I take you to court, I got more costs. So that $1,000 is unsecured. Well, that doesn't mean I'm not willing to do the loan. Doesn't mean that I'm not willing to put that money out there for you. It just means that I am going to make some more money on it. I'm going to charge you higher interest. It's a riskier loan for me, so I'm going to try to reimburse us for that risk by having a higher interest rate. Hope that makes sense. So that goes into the collateral. If I am buying a house at 100%, I'm borrowing 100% of the value of that house, and you stop making payments, when I get that money, can I sell the house as a lender? Can I sell that house and make up every dollar to pay off the money that I put out in this? If it's at 100%, that's a higher risk than if you're only borrowing 80% and you put $20,000 down for every $100,000 of borrowing. $100,000, $20,000 down, $80,000 loan, 80%. My risk is less at 80% than it is at 100%, because I will likely be able to recoup all the money that we have invested in this loan. And that's what we really look at it like. That's an investment in a loan. That's an investment in you. We are investing $100,000, assuming that you're going to pay us back at X rate for the next 15, 30 years, whatever that note is. We always have to look at, well, what if they stop paying? What if we get this back? That's where the risk comes in. And the higher the risk, the higher the rate. Same thing with cars. Same thing with anything. If it's an unsecured personal loan, those rates are higher because there's higher risk for the lender to give you that money. So that's the collateral C. Then character. This is kind of a different thing. Character is more about who you are as a person in your life. Have you been at the same job for a long time? Have you been at the same residence for a long time? Uh, um, have you had a relationship with this lender for some time? It's who you are and how you live your life. That's more of the character. So somebody that's jumping from job to job to job is going to be a higher risk. Again, I'm not saying that we'd say no. It's just I'm going to look at that as a higher risk borrower. And so that rate might be higher. So understanding these things about you, do I move from job to job, or am I every 6 months I'm in a different apartment? That is somebody that any lender is going to look at and go, that's a higher risk. You may have been paying your bills all the time and your credit score is actually excellent, but because you move every 6 months and you've changed lots of jobs, you're going to be a higher risk. Again, your credit score is good. I might do it, but you might be paying a little higher interest rate because you, as your character, is a little bit riskier. Does that make sense? Okay, got no questions on this so far. So, and capacity. The capacity is the final one. This is about my debts compared to my income. How much money do I have going out compared to how much money I've got coming in? And it's a percentage of looking at how much free income they have after their minimums are paid. How much do they have beyond that? And obviously, the higher percentage of what your money going out is compared to what's coming in, the higher the risk. Again, doesn't say they don't do the loan, but as that risk goes higher, so what should we do? Having less debt going out, having a less percentage of our income being paid out on things like, and by the way, usually we are just looking at things that would appear on your credit report, like an auto loan, like credit cards. A rent, we would consider whether it's on your credit report or not. Those things that you have to pay month to month. We're not going to be considered looking at utilities. We're not going to be looking at those because those are built into the ratios. Where they're built into what the company has decided. We assume that everybody has electricity, water. We assume that everybody has that. So instead of having to get you to tell us what your electric bill is, we assume a dollar amount and that's built into the ratios. So that's capacity. How much can I afford? All right. So here's a quick scenario, and I'm going to try to go over this really quick. This is an actual person that came to me as a credit union. By the way, we're not for profit. Do we go a little bit? That's not that we don't make profit, but our job is not to make profit. Our job is to keep our cost low. One of our jobs is also to try to find ways to say yes. because you're members, you own a piece of the credit union. So we really, really work hard to try to say yes to you. And here's a scenario like that. Look, this is a guy that came to me. This was probably 30 years ago, 25 years ago when I was a young loan officer. Now this guy came to me. His credit score was 525. Without getting deep and bogged down into credit scores, 525 is not good. If you're in a 525 credit score, there's some improvement that can be done. And we have a class on that. So please look at that. Look at the opportunities for us talking about credit scores. Um, he wanted to buy a car. He wanted to buy a 3-year-old car, and he had zero money down. So he was going to borrow 100% to buy this 3-year-old car. Didn't have any money down. Like he'd been with the same company for 15 years. He'd been in the same residence for 20 years. Is his character solid? His character was solid. He'd been with the same company for a long time. His capacity right now, well, at that time, his capacity was great to pay for this loan. He had more than enough income to cover all of his bills and this new loan. And does something seem off? And something is off. If he had been with the company for that long, been at the same residence, had plenty of income to pay for his bills, how come his credit score is 525? And how come he has no money to put down? Oh, those are great questions. Um, Here's the rest of the story. And this is where a good loan officer is looking at something, and he could see the story of your life, um, of the last 2 years within how you pay your bills. And look, he was perfect up to a certain point. He had gotten laid off. He'd been with that company for 15 years, but he got laid off. He had savings, and he went through his savings. He blew through his savings to pay his bills until he had no more money. Now, the awesome thing that happened, well, not the awesome thing that happened. This is the horrible thing that happened. His credit score dropped. He had no money, and now he can't pay for his loan. He got his car repossessed. Now he has no car. But here's the awesome thing. He'd been with this company for a long time. They restructured, and they hired him back. They bridged him so it was like he never left the company. They even gave him a raise. They restructured well, and he's making more money now. But now he needs a car to get to work. And he came to me looking for that car. He had no money down because he did I do the loan? I absolutely did the loan. And by the way, he turned out to be my best customer. He told everybody to come to me because everybody else that he worked with had been laid off too. And they were all hired back, and they were in a similar situation in need. We were doing loans left and right to take care of this group. His character and his capacity definitely put him over the top when his credit score and his collateral were not solid. So I'm proud of what we do as a credit union. And here's where we're going to get down to the true cost of credit. Look, is it the interest rate? Is it time? Is it the amount? I will tell you that most people consider the interest rate. And I'm saying the interest rate is very, very important. But what is even more so important is how long you are in that loan and the amount that you borrow. If you have no money down, then I'm talking very, very simply on a $10,000 loan. If you put $1,000 down, I'm only charging interest against $9,000, not $10,000. My interest rate is charged against the amount that you are borrowing. That's why the amount is more important than the interest rate. Regardless of what the interest rate is, I'm charging it against amount. If that amount is lower, you're paying less interest, regardless of the rate. That makes sense. Time. I'm also charging it over time. So the less time you're in the loan, the less cost of the loan, regardless of the interest rate. The interest rate, by the way, is going to be your rate. It's going to be the rate because of the internet, because we have such ability to search and find competition for. There's such competition for your loan that it evens out our rates a little bit because we're shopping too. I know what the competitors are doing. Now, as a credit union, do we have better rates? Yes, because I'm not making a profit for investors on Wall Street. I am saving money for our ownership, which, if you were a part of our credit union, would be you. So why would I charge you extra money just to give it back to you and dividends paid out? No, that's not how we work it. We make sure that we have the best loan for you in your situation at that time. That makes sense. So really simple. Below the true cost of credit on your screen, you'll see that it's about how compound interest is calculated. So this is how it goes. It is whatever your interest rate is. Let's say it's 8%, divided by 365 days. So interest is applied to you daily. So 365 days of the year. And then we'll look at what your balance is on your credit card, what that current balance is of it, and it is charged daily. That daily interest rate is charged to whatever that balance is per day, times 30 or 31, depending on whichever company it is. But generally, it's going to be times 30 days, and that's the monthly interest. So you see, the interest is the only thing that's consistent in there. How long and how much changes, and that's what we can control. We can control how long and how much. You control a little bit by getting your credit in, but the credit in better position, so you have a better rate. But that's the most of your control about the rate. How much you borrow, how long you take to borrow back is the most important things in the true cost of credit. So rate is only the one factor. And moving on. So payment is not the price. This is one thing to understand overall. And these are three different scenarios, and it's a combination of different things. So this is if I had $5,000 and I was going to buy a living room. I was going to buy a living room suite, the couch, chairs, all of this stuff. Look, if I did a loan at for 6 years at 21%, now that payment is $123. The interest that I would pay over the life of this loan over the 6 years is $3,833. So my total actual cost of purchasing the $5,000 and the interest on there is $8,833. That's a 6 years loan at 21%. Now let's take the same loan, $5,000 borrowing to purchase this furniture at 21%. The interest rate is exactly the same, but now I'm doing it 3 years. That payment's $188. All right, so it's $45 greater than what the payment on the 6 years is. Only $45. But here's what $45 is going to save you. Over the life of that loan in 3 years, the interest cost is $1,781. My total actual cost for 3 years for paying $45 more a month is $6,781 of actual cost. Time. Time saves on that. This interest rate is the same. All right, now let's look at the amount. If I only borrowed, if I had $2,000 down, I did not need to borrow $5,000. I'm only borrowing $3,000. Again, it's 6 years. So going back to the original one, 6 years at 21% interest, interest rate is the same. My payment is only $73. Why? I'm only borrowing $3,000 over 6 years. Now my actual interest cost over that time is only $2,300. That's interest paid. My total cost, $5,230. Do you think putting $2,000 was a big savings? Yeah, yeah, it saved. It saved a lot. We're looking at what 230. We are talking about almost $1,000 in savings because I put $2,000 down over the life of that loan. Is time and down payment and amount very important? Absolutely. So here's a little behind the scenes look at salespeople, and how they use payment to close the deal. So it's about painting the picture. And I'm going to go through this pretty quickly. And by the way, a large lending group that I used to work for many, many years ago, taught this, and they taught this well. And they were one of the biggest lenders in the world. And it was eye-opening to get back and look at this is how they're selling. So it comes to this, and I'll use a mortgage as an example on it. It's about painting the picture for you, and it's about painting the picture of you decided to go out and you wanted to buy a house, and you've been looking and looking around, and you were talking to your mortgage professional, and the mortgage professional is going, okay, so I've approved you for $430,000. You're like, well, that's outside of my budget. We only wanted to spend $300,000 because we had a payment that we wanted to be, and the $300,000 payment is great. Okay, great. Well, go look. Wow, we found the $400,000 house, and it's perfect. It's in this neighborhood that we love. It's really great. Got God, I could see our kids growing up there. This is really awesome. But it is out of our price range. So then we found this other house that we really, really, really like. So, so Mr. Mortgage Lender, I want you to take us through the process of borrowing the $300,000 to buy the house that we really like. Now, here's the painting the picture part. And this is how they use payment. Well, you had a certain payment that you wanted there with that 300,000. I got it. I got it. Man, that $400,000 house. I tell you, that had everything you said you would. I could hear in your voice how excited you were about what it had a pool in the backyard. It was in a community that had the best school that you've ever seen. So you can imagine your kids going there. You can imagine your kids' friends coming every summer and being in that pool. Gosh, you talk so passionately about it. Like I hate you to miss that $400,000 home because that's really where you'd like to be. I mean, if we got the payment right, wouldn't that be where you would live? Well, what if I could tell you that I could do that? You wanted a payment of $1,800. What if I could told you that just for $2,100 a month, you could get the $400,000 house? Would you do it? Well, what have I done? So now I've sold you on the dream that you had. It's only going to cost you $300 or more a month to be in that. Well, that's something that is at the top of my budget, but I could do it. And I've sold you on $100,000 more loan than what you originally wanted to do because I talked to you about the payment that you could afford and wanted and painted the picture of this dream that you would have. Look, be careful of payment conversations. Understand who you are and what you're looking for because they will use these opportunities that you they ask you questions to paint a picture to sell you into something more. Why would they sell you into something more? It's not because they don't get a flat rate on one loan. Their income is based on how much you borrow. So it behooves them to try to sell you more. It behooves them to try to put you in the maximum amount of debt that they possibly can because they make more money doing that. Be careful of payment conversations. And this goes through almost everything. All right, so keys to the house. We began talking about house. Uh, um, Anybody have any questions before I move on to the house? I'm looking through here. Should I close old credit cards I'm not using? Like, hey, that's a really great question. Um, um, so your credit and look for our credit class because I'm not gonna get bogged down by doing this here, but ultimately it's a yes and no thing. Um, I would say yes because one, if you're not using them, I'm not seeing a payment history and credit building the credit. I need to see a history that you're making payment. This is flat. There's nothing going on in that, so it is really not helping me. What it is doing is giving an opportunity. So here's one thing to know about it. When you have, let's say you have a $5,000 credit card for emergencies, but I don't use it. I don't use it. When I am making a decision about you as a borrower, and you have a $5,000 line of credit in a credit card, I have to assume at any point in your life you can charge that up. I've got to assume that because any point in your life you can charge that up. It creates risk. So should you close it out? Yeah, I would say yes. Why am I questioning whether you should close it out or not? Well, what I don't know is I'm not looking. Everybody's individual thumbprint on their credit is different. I don't know if that's the only trade line you have. Each piece of credit that you have, whether it's an auto loan, a credit card, mortgage loan, whatever it is, each is a trade line. It's an individual trade line, and I have to look at each of these trade lines. If you only have one, then I really don't have anything to build a history on how you perform. It doesn't give me enough to make a decision. Hope that makes sense. We go into a lot more depth into my credit class, so check it out online. Love to talk about. Send me an email. I'm happy to give you some information on that. So thank you. Sorry that I probably didn't answer the question really well, but that is true. Yes or no. It really kind of depends on your total portfolio or your total credit picture, and everybody's an individual. By the way, I'm going to use this as an opportunity to say, stop comparing yourself to other people. Stop it. Everybody's different. Their walk through things are different. How much debt, how much income, where they have lived, like their whole picture is different. So you can't look at your neighbor and go, well, they got a 3% interest rate on their home. Why don't I have a 3% interest rate? Well, hey, I'm going to tell you the honest truth. They never missed a payment. They have very little unsecured debt, and he makes a lot of money, or she makes a lot of money, or they make a lot of money. That's why there's 3%. You have several late payments. You make just enough money to cover this mortgage. Your interest rate is going to be higher. I hope that wasn't too harsh, but this is the truth. This is why somebody would have a better interest rate than others. Uh, um, so moving on, understanding whether you're ready to go get those house keys, or refinance, moving, whatever it may be. There's a lot of things to consider. You want to know the type of team and who you've got behind you, who you are working with, and know the options. And there are several options always out there. Um, so go. We just talked about the four C's. Uh, um, Considering that as you are moving forward, it would help you to say what type of loan. Like there's many. There's FHA. There are a couple of different versions to go with whether you have a 500 score. I don't see a lot of these getting approved, but this is available out there and only 10% down. What do we talk about? If the less down payment you have, the more you're paying over life. Um, uh, uh, VA loans, 580 starting. FHA loans with 3.5 down, they start at about 580 on your credit score. So still not a great credit score, but you can do these things with very, very little down. Now, understand when we're talking about FHA loans, you're going to be talking about some other fees that are going to be tacked onto this loan, likely for the rest of the life or until you refinance it. So there's some cost in there. Can you have a really good rate? Likely, even with some poorer credit, yes, but there are some extra costs. So you need to understand all of those costs that go into that. And we can go deeper into that in a specific mortgage class. I'm doing an overview here. What's your gross income? And generally on the front end, and that's talking about your house payment alone. You want to be your debts compared to your income on that. Your would be about 28 to 31%, depending on the loan type you're at. The back end would be the total cost. And I'm not talking about things like your utility bills. I am just talking about the things that would appear on your credit report. The total be, depending on the loan, 36 to 50%, basing on the loan type. So after all the loan is done, after you have either refinanced and or purchased or whatever that may be, after everything is said and done, your total payments can be no more than 50% of what your total income is. Make sense? Okay. There is that. That is how your gross income is affects the mortgage, and if you are ready. Um, do you have a down payment? Look, 20% down saves everything. There is private mortgage insurance on loans that are anything greater than borrowing 80%, 85%, 90%, 100%. If it's greater than 80%, if you have less than 20% down, then there is going to be a private mortgage insurance. Now, this should go away when your loan compared to your value of your property is less than 80% of the value of it. Now, there's some hoops that you generally have to walk through. It doesn't just automatically disappear. But so there's some avenues for you if you're borrowing greater, but that is a big, big deal. If you've saved enough to put down, one, I already talked to you about credit. We know that every dollar that you borrow is a dollar that a lender is making money off of you. It's an increase in interest. We talked about the amount. So obviously saving to put down is going to save you money in the long run. But in a mortgage loan, it can even save you more if you've got 20% to put down. Not just talking about borrowing 20% less than the value of the property, but also about not having the private mortgage insurance on it. So saving some money is important. Does it kill a deal? No. Something that you should know and understand. Um, how long have you? How long are you going to be in this? How long have you been working at the same job? How long have you been in the same residence? So these things are going to get, typically the industry is going to want to see you about 2 years in the same job or same field. It's okay to make moves within the field. Like if I worked in IT and I don't know, I was an engineer, and then I moved up into management, or I moved into a different part of the same company that I worked for. Well, that would be but if I was an engineer, and now I decided to be a painter, all right, well, that's two different things. And now I don't know. I know this history of you as an engineer. I know nothing about you as a painter. It comes into the effect of whether we would do the loan or not. So they're looking at a 2 years solid in the same field. You can change jobs, by the way. If I was an engineer at one company and I moved to another company 6 months ago, well, that doesn't exclude me from being able to get a loan as long as I've moved from as an engineer to an engineer. There is a connection from what I was doing before to what I'm doing now. We're looking for some sort of connection, and so that we can understand this is the borrower today that we're looking at. It'll also be the same borrower as tomorrow. So the people that you're going to be dealing with, real estate brokers, those that help you to find and sell and purchase homes, mortgage lenders, those that are giving you the money, appraisals. That's something I said. There's going to be an appraisal done. So this is talking about what the true value of that property is. And appraisals are built on this. Appraisals are built on cells when we're talking about mortgage loan, of how many other like properties in a like area have sold. And they're going to look at those, compare them to yours, and either addition or subtraction of to come up with the value of what your home is. So that is appraisals. There's going to be a title company. We're going to close, and the title company is the lawyers to go. The property is properly moved from the ownership of this one person to the other. They're going to take care of all the documents to make sure that insurances are in place, that the names are in the proper place, that the ownership, and then also the liability, and who is going to be paying for X, Y, and Z, where that comes from. And in that process, they use surveyors and they use inspections to make sure the property meets guidelines, that it is stable and livable, and the values are true there in that property because it. And then the surveyors to make sure that your property that you're purchasing, your future property, is not encroaching on any other's property. This is also a big thing to make sure that nobody else has a claim to have ownership of that property. So that's where the title companies come in, and every state has a little bit different. So your loan options, like here comes the conventional or private investors that invest in mortgage loans. If you're like I talked about, if you're borrowing more than 80%, you have less than 20% to put down, there's private mortgage insurance. And that insurance is not for you, that insurance is for them. If you stop making the payments, the private mortgage insurance is to kick in to recuperate the private money for them. It's not a benefit to you, except for this one thing. If you didn't have the PMI on a conventional loan, you would not get the loan if you were borrowing greater than 80%. That is its benefit to you. Uh, um, there's no upfront funding fees generally. There's fewer property restrictions. So the house that you want to buy is the house you want to buy if they want to invest in you buying that house. It's generally best for borrowers with stronger credit. They're generally going to go for more of a conventional loan. Now, if you have some credit issues or you have some other needs or you're borrowing, then the government-backed FHA or VA type loans are solid. Their interest rates are going to be a little bit better, but they're going to be just more strict on the property itself. So you need to understand the property may not qualify for an FHA or VA loan. They also have funding fees. So there's stuff that gets up front. They also will come with PMI or MPI, which is mortgage price. That is the insurance, and they're very hard to get off. Even when your value goes below 80%, it's very hard to get off. Whether you're borrowing 60%, 80%, 100%, whatever you're borrowing when it comes to these conventional loans, that payment is going to be on there. It's going to be addition. So know the cost. So when you're looking at a rate that might be a little bit higher in a conventional, your total payment may be less than what you have with an FHA lower interest rate that has the MPI that is put on it. So understand those things. I'm happy to answer any of those questions. I said it before, a thing a thing has value if somebody's willing to pay for it. And that's where the appraisals come in, both in car and a home. If nobody's willing to pay for it, it has zero value whatsoever. And that's when people are not buying houses. That's when property values start going down. We happen to be in a market right now where people are buying and values are up, especially here in Texas, where we have people moving in from all over the country, and our property values are generally steady and higher. Um, so somebody's going to come in and they're going to base on one other properties that are in the neighborhood. You can't look at even the exact same home built in another subdivision that is just right across the street, especially if it's a main road, a main thoroughfare. That is a different subdivision than yours. That value will hold nothing to what your value is. They're going to look at close radius without uh, um, any other, any encumbrances that are like boundaries, city lines, whatever that may be. So it's close radius internet, and they're going to make an adjustment to the size of your house, the amenities, the different types of things, the construction, how the house is it in good shape, is it not? They're going to make these comparisons to get down to what a value of yours is, because based on what other people have purchased will tell you what the value of that house is. The same thing with a car. Cars are a little bit more volatile on that, but they're going to look at a similar car, similar sales across the nation and locally, to determine that this car in this condition has a value and somebody would be willing to pay for that. And that's what we use to determine what your loan compared to the value is, regardless of how much money you put down. All right, so moving on to keys to your auto. I don't see any mortgage questions, but hey, please feel free to get to the end of this and email me if you have any questions. I'm happy to answer those. Hey, buying a car. Look, do some research. By the way, get pre-approved. Get pre-approved on your loan. Get pre-approved on your trade-in. There are many groups out there that are those that will give you a valuation of your car. They will give you a valuation that they would be willing to pay for your car. So before you go in and you talk to a dealer, know what somebody else would pay for your car. Gives you power, gives you opportunity. Have a loan approved, hopefully from a credit union, hopefully from City Credit Union. Have a loan approved before you go in there. Have your own numbers before you start talking numbers with them. And by the way, I've got a video out talking about numbers. The numbers aren't numbers. The numbers aren't just numbers. It's your trade-in. It's your asset. It is a debt that you are going to be obligated to, unless you're paying cash for it, which still numbers. It's money coming out of your pocket. Know your lending options. Hey, be aware of loan creep. We'll talk about loan creep in just a second. And zero financing may not be zero financing. You got to look at the total cost of everything. Like, as I said, know your price. Know what you want to pay before you go in there. Get pre-approved. Make all of those decisions before you walk in. Hey, they may have a better deal for you, but know what your bottom line is before you even walked in. Know what your trade in is. Just as I said, check the online resources. They will give you, here is the value within the next X amount of days, whatever company it might be. We will be willing to pay this to you for that, so that you can go in with that money and just make a cash deal. Lots of times, by the way, they will even write a note to that dealership that says, dealership, we are willing to pay $10,000 for this car. We will give you $10,000 and come pick up the car from you. So know that those are some options that are out there, and do plenty of research before you go in. And have all that in mind before you even sit down and start talking with them. Know what you want. That'll give you more power. It also gives you the power to walk away. By the way, walk away is a very, very strong thing. Um, know your lending options. Be careful out there, though. Loan creep is a big thing, and this. If I know that I'm comfortable at making a $350 payment, and I was going to make this $350 payment over 5 years, I was going to do a 60-month loan, and that's what I wanted. I walked in there, but there was a brand new F-150 that was loaded, that was big for a big guy like myself. I would have been really comfortable with. It's got all the bells and whistles, and it looked pretty, and I could see myself driving that car. They're like, well, is that something you want? Oh, it's something I want, but I only want to pay $350 a month. Well, if we extend this loan out for 7 years, by the way, I know the scenario I just talked about is not possible because that F-150 I'm talking about is much more expensive than that, and it's never going to be $350 for 7 years. I know that. Just work with me here. So if they come in and they creep my lifestyle into an extended payment, well, what is it? We're talking about time. That's going to be more expensive in the future. And by the way, the zero finance trap is this: they are not going to rebate as much, so you are still buying the car at maybe a higher rate than something with financing with a interest rate would be. So you want to look at the total deal. And if you have those things, like you've done your option, you've done your research, and you have your loan, you have your trading, you have all this stuff, now I'm in a power position to be able to negotiate with you. And we actually have like, as I said, coming up, I'm going to have a professional that bought cars for a dealership for 30 years. He was a wholesaler that we're going to go really, really deep in depth in the next few weeks talking about this. So please check us out on Walks with Percy, and you'll see these opportunities coming up. And we are coming into the end of this, so I'm going to finish this stuff up. So keys to recreation. Look, remember that if you bought a boat, you bought a jet ski, you bought a dirt bike, whatever you have, like you're going to have to keep those up. So there's going to be some extra costs. It's not just can I go to afford to spend $5,000 on this motorbike to that I can go out every weekend. Then it becomes every other weekend. Then it becomes maybe once a month or whatever it may be. Or boat. I'm going to be on this boat all the time. We're going to do this. Well, I'm going to have to store that. I'm going to have to upkeep it. There's going to be some other cost. It's not just can I make this payment over the 10 years that the boat loan is. Uh, um, and by the way, 10 years, the boats and stuff can be a longer term. RVs can be a longer term. Why? Because they don't lose a whole lot of value. If I'm willing to buy a boat, if I'm wanting to buy a boat, I'm generally willing to pay for that. And their values don't tank as quickly as like a car, which loses value as soon as you drive it off the lot. So it's not as affected, but it is affected by depreciation. So understand that those costs are going to be in that. And hey, look, I'm going to talk about savings and savings and savings, and I'm going to talk about more savings. Keys to life. This is your future. These are those things of instead of financing $10,000 to have this awesome vacation in Paris. And I don't know why, by the way, if you're seeing this, Percy is in Paris eating spaghetti in front of the Eiffel Tower, but that's what AI did. And I couldn't get it to change to something else. Anyway, there it is. Um, Financing that is hard. I can tell you that we spend a lot of time ourselves. We love to travel. We were talking. My wife and I were talking this morning about wanting to plan a trip in 2027, and I started doing the math because like, well, that means after our next big trip that we take, we're going to have to start saving $150 every week until that to be able to pay cash for it. And now we're already working on a plan of how do we do that? How are we going to put $150 aside from our standard budget? This is extra spending that I want to do. How am I going to do that? And I'm going to do that because we want to take this trip. I'm going to find a way to do. I don't know how I'm going to find a way to do it, but we just began talking about it. You should be talking about that. Talk about how we can put a little bit aside today for that thing that we would want to do tomorrow. Look, I can tell you that when we pay cash for our vacations and we sacrifice to save to pay cash, I can tell you that we enjoy the vacation much more because the whole time we are not sitting there going like, God, we're going to have to pay for this. We're not worried about that because we've already paid for it. It makes the vacation much more sweet. So I really, really talk about doing that. And by the way, beware of buy now, pay later stuff. Buy now, pay later can wreck you because it's 0% interest. But if you miss a payment or if something happens and you can't make that payment, that 0% interest goes up to 36% in most cases, somewhere around 36%. And it's retro back to when you first borrowed the money. It is not whatever you've whatever your balance is from then on. It is retro back. So if you borrowed $1,000 and you had a $50 payment left and you missed that $50 payment, it's not going to be charging you 36% on $50. It's going to be charging you 36% on $1,000 for whatever life of that loan was. If it was 6 months, 5 months, whatever it was, $1,000 based on that. They'll probably offer you a credit card or something, and then you are locked in for that 36% for until you pay it off. So beware of those. They're out there. It can be a trap. So keys to freedom. Look, I will talk about savings is freedom. Savings isn't about building massive stuff for your future, but it gives you that foundation for freedom. It gives you that foundation to make choices. Here, I talked to a lot of people that are in full commission sales about this. If you don't have that war chest of savings built up, when you are making a deal and your lifestyle is built on the commission of that deal, but you need that money to pay for your car, to get from A to B, to make find deals, or to just eat next week, to feed my family, to pay for my rent. Might you make a bad decision just to get that deal done? Are you in a negative position when it comes to being able to negotiate? Or are you in a power position where you need that money? It lessens your power if you don't have that savings or that war chest. Look, savings goes for everything. Can I walk away from a car loan because I don't like it and I can go somewhere else, or I have the savings to just pay cash? I don't have to have this deal. Look, savings gives you power for opportunities. Can I leave a company for a better opportunity? A friend of mine actually just changed careers completely. And I asked him recently, like, how did you do that? How could you had been in this business for a long, long time, and now you've completely changed in our age, we're in our 50s. How do you make that type of change? He said, I saved enough money. I wanted to do this. I've been wanting to do this. I've been talking about this for years. And we saved enough money that I could change that career, something that would be better for me and my family, because I saved the money to live on until we were back into a good position. I paid off debt. I put us into a position where I could afford to take that hit for a certain amount of time. Savings gave him opportunity to change his life. Savings is powerful. Have a plan. Don't just hope that you get there. Make a plan for where you want to be, for where you want to jump off. Make a plan for how we're going to invest. Know what tomorrow looks like for you, and understand the real cost. Understand where the fees are. Understand what the interest is. And we can go in deeper. Would love to talk to you more about that. Reach out to us at City Credit Union. I am Charles. And if you come to our page, just pulling up, like, if you come to our page, if you use this QR code or you go to www.citycu.org, you will be able to reach to me. There'll be an education tab, and you will find my information there, where you can email me and contact us, and we can help you out. I have several other classes that are online and in person. You can also see you can see our calendar of classes that are upcoming. If you're in the Dallas-Fort Worth area, we do classes at Dallas College, and they're free. Some of them are lunch and learns. So if you go in for one of those classes, you might come, have a free lunch, and we'll talk about money. The classes that we've got going on right now is Adventure Budget Land. It's really about budget and building that budget, how you maintain it. Credit Essentials, if you're needing credit repair, maintenance, we're talking about all things credit, how to put yourself in the best position to do these things out in the world. Because I got to tell you, look, because things are so expensive, I can't begin to tell you that, hey, you should be debt free right now. Like, debt is a thing, it's a real thing, and it's out there. And how do we best position ourselves? I do a fraud class, so understanding fraud and how to protect yourself from fraudsters. Also, how to get your money back if you happen to be frauded. Boy, most people are going to be touched by this, so it's important. Blueprints for Financial Freedom is a class I did earlier today. These will keep going on about building those foundations for your future and how to make your money work for you. And the class that we've just done, we'll do keys to the keys before. If somebody else you think needs some help or would like to hear it, hey, please share this with them. This is free for everybody. Last two minutes here, I'm going to talk about the City Credit Union and the heart of a credit union. Look, they have me doing this because our board of directors and our CEO and everybody about it is about educating you. It's about making sure that people handle their money well, that we give them an opportunity. Like, this is not, you don't have to be a member. We want you to join. Love to have you. You'll find wonderful, amazing service from us. You will find great rates. If you need to refinance that car, call us right now. We'd be happy to help you out. That is what we do, and at a fantastic rate. They care enough about this that they bring me on specifically to do this and to have one-on-ones, whether you're a member or not. So, hey, reach out to us. It's real. City CU, CITYCU.org. Look forward to talking to you again. Thank you. Guys, I hope you enjoyed this. Drop me an email. Let me know what you think. And I look forward to talking to you guys again. Thanks a lot.